Welcome. My name is Sasha Moore, and I have Matthew Porch, Head of Distribution at Aquamore, with me today. Welcome, Matt.
Hi, Sasha. How are you?
I'm good. So I really like this new campaign that Aquamore is doing, which is the myth-busting series about private lending, because there is a lot of talk about the sector and there is a lot of historic associations with private lending. So I'm going to hit you with some myths, and I'd like for you to really give your perspective of whether or not that myth is true or false.
Sure.
So the first myth that we have today is that private lending is only for borrowers with bad credit. True or false?
That's unequivocally false. So,
Okay.
Look, we do see borrowers with, and I'm going to put it in, inverted commas, bad credit. I think that the way that especially some of the major lenders assess bad credit is outdated. I mean, you can look at your own credit score, for example, and you might think, why is the score so high or why is the score so low? It could be a number of factors as to why your credit score is where it is. Lack of inquiries, moving address, moving jobs, things like that, where, as I said, I think a lot of that credit scoring stuff is now outdated. There's always a story behind why a client has had a default or why they've had bad payment terms, and we're open to listening to those stories, especially with small to medium enterprise trading businesses where people get involved in trade disputes. There's always a problem when running a business. Running a small business is never easy, and we appreciate and understand that, whereas your major lenders and even your second tiers will see a judgment or a default or whatever, and they'll just say blanket no on this one, which again, in my opinion, I think is a very short-sighted approach. So yeah, private lending, we will assess the story as a whole, but we get a lot of very good credit borrowers through the door as well, where it might not be their credit that's the issue. There might be a problem with the exit strategy or the security, or there has to be something else that doesn't quite fit into a policy-driven lender's book. So yeah, I think that the bad credit piece is certainly a secondary consideration in the overall picture.
And I think you touch on a really interesting point, because that term bad credit has really morphed a lot over the decade. Yeah. And I think people still do have that association of perhaps, 20 years ago or whenever it was when that term started to be used, or the non-bank sector started to emerge and be associated with a really actually dire bad credit borrower. So for me, having now been in industry to sort of see the different stages and the different vernaculars that are used, I think you're absolutely right that it's very easy to pigeonhole a term, but that term has morphed. And if your perception of it doesn't carry through to really be reflective of market, you're not truly then potentially understanding the actual borrower and therefore the lenders which are appropriate. And I also think, particularly in the current state of market, as you say, bad credit is or good credit is subjective, right? So, and we would never have forecasted today the types of deals that are being rejected by traditional lenders. So I think that I think the main note to that would be that, or main takeout is that bad credit is a loose term, and it doesn't equate to loan sharks, and it definitely should be dropped in terms of the stereotypes that are associated with it that perhaps are basically prehistoric.
Yeah, absolutely. And I think the days are gone of, unfortunately, there are still predatory lenders out there, but I think there's far less of them now that, as you said, the market seems to have adjusted, and there's a lot of very good brokers out there who really understand the lending space, and they understand that there's a home for a lot of deals. And, that's, as you said, that term has evolved, and I think a lot of lenders like us have evolved with it. Unfortunately, there are still some prehistoric lenders that will charge what they'll put on as a risk premium based on factors that may not necessarily make sense. But what we do, it's all judgmental, case by case credit assessment. So
No, indeed. And I think that you also raise an interesting point in terms of the private lending space itself is, you know, the style of credit and the access to funding lines has changed quite substantially. So I would also encourage brokers to really ask that question of a private lender in terms of to describe. So is that warehouse institutionally funded? Is it through a consortium of brokers or people? Like, where is that, what is that funding base coming from? Because I think that would also give an indication to both the process as well as likely outcomes of that dealing with that lender.
That's right, and that's a very important point that you make. Is it's paramount to understand where the money does come from, because that will help dictate, first of all, the terms of the deal, the structure of the transaction, and most importantly, the cost of the deal itself. And again, if you're dealing with institutionally funded lenders, obviously there's a lot of compliance, there's a lot of hoops to jump through in regards to, first of all, sourcing that money, and second of all, keeping the warehouse facility open. So it gives a lot of credibility to those lenders that can satisfy those requirements, and it should be giving brokers and their subsequent clients comfort in who they're dealing with.
Yeah, absolutely. And I mean, I guess also at a very basic level, that if you know, you are putting through a deal, and particularly if it's a larger size ticket, that once that deal is going to be funded, there is actually the cash available at from the lender's perspective to fund that deal. So great, always, as always, to speak to you, Matt, and I will look forward to next time.
Thanks for your time. Cheers.
Thank you.